Hello and welcome to Market Domination. All eyes on Fed Chair Jerome Powell's position today in a major will he or won't he be fired by President Trump. For now, the president denies an earlier report that he was closing in on that move. We're going to have all the details of that back and forth and how markets reacted. The news whipsawed markets during intraday trading, and right now there's just an hour to go until the closing bell. Stocks are mixed here. Let's welcome in Chris Versace. He is Chief Investment Officer at Tematica Research, and our very own markets and data editor, that would be Jared Blickery, who are joining us throughout the show to break down the headlines. We're going to right now go to Jared with a detailed look at that whipsaw timeline. Jared.
Yeah, well, let's take a look at the Wi-Fi Interactive here, and I'll start with the Dow. The Dow is now up 216 points, or about 0.5% here. And let's just take a look at the intraday price action, because you can see we took a nice dip into the red there. New York Times apparently got a hold of a letter that was outlining how Trump was going to fire Powell. But yeah, guess what? That was walked back a short minute later. And in fact, we actually have a clip of that. Let's play that right now.
No, we're not planning on doing anything. We're very concerned. He's doing a lousy job, but no, I'm not talking about that. Fortunately, we get to make a change in the next, 8 months or so. And we'll pick somebody that's good, and we'll pick somebody. I just want a fair job. We want to see lower interest rates. Our country deserves it.
So maybe the markets get a reprieve, maybe Powell gets a reprieve. What I'm looking at here is a prediction market on Powell's exit, and this is intraday, this is from Polymarket, and you can see the fireworks here. This is the exact opposite, the reaction that we saw in the stock market. The odds went up all the way to 40%. This is the highest amount on this contract going back to January 30th. In fact, it's double what the previous high was, which was about 20%. So markets take this stuff seriously, and I want to point out some other markets that really reacted to this quite strongly. I'm going to dive straight into the bond market and go straight to the 30-year yield, because here is that reaction. Now, we were below the critical 5% mark, and if you've been listening to Yahoo Finance, I've been talking about this nonstop. 5% is a critical threshold at which stocks do not like to see those yields punch above. So after the statement was walked back, yes, we came down a bit, but you can see some damage has been done, and we're still sitting above that critical 5.02% threshold. And it wasn't just the bond market that took notice. Here's the US dollar index. That took a dive here and recovered somewhat. And also, we can also take a look at gold futures. We saw a big spike right here, settling about 33.57. But as you can see, some of the markets gave back those gains. Some of them only gave back a partial amount. So let's flip on over to the sector action and take a look at what's happening here. This is almost a mirror image reversal of what we saw yesterday, where we only had one sector in the green. That was XLK Tech. But today, 10 of the 11 sectors are in the green. The only thing that is lagging here is energy. Healthcare up 1.3%, real estate up almost 1%, and financials, with some of those big bank earnings still rolling in, that is up 0.75%. Finally, communication services up 0.6%, all of these outperforming. So I'll show you the NASDAQ 100 here. NVIDIA holding on to some very small gains, so is Microsoft. Apple up about 0.6%. Amazon, Meta, Broadcom, they are taking some dips. Semiconductors had a great day yesterday, and we're seeing some additional gains today. AMD up 1%. But another aspect of the market that I was focusing on yesterday was small caps. Those were leading down. Today they are leading up. And I just want to show you what's happening in meme stocks. This is true risk on action that we're seeing right here. Hood up 4.5%, Coinbase up 4%, Circle up 22%. So I'm not saying we're back, but I think markets are very relieved here.
All right, Chris, I want your take as well here on the Trump-Powell headlines. You were reading those headlines. What'd you make of them?
I think the president is trying to find some scapegoat for his tariffs and trade deals that are just getting extended. I think when we look at where inflation has come, look at the CPI data for June just out yesterday, or the longer term trend in it. Clearly inflation is picking up. We can trace this back to tariffs, and Trump, as usual, is looking for a scapegoat. So to me, there's a lot of noise in here. Do I expect Trump to actually fire Powell? I do not. But we're going to see a lot of uncertainty back and forth. And the longer that Powell and the group that heads the FOMC keep rates at elevated levels, the more noise we're going to hear from Trump. My strategy is follow the data and just ignore the noise.
And Chris, do you think Jay Powell is ignoring the noise. I mean, he's reading these headlines. I mean, I'm just curious, what do you think he makes of it? Do you think does it motivate Powell to give Trump what he wants? Does it have any impact at all?
I think that Powell would like to deliver a rate cut. You know, recently he said that if we didn't see tariffs and see the inflation that's coming back as a result of the tariffs, the Fed probably would have delivered a rate cut by now, but there's too much uncertainty. And remember, that level of uncertainty about tariffs over the last week has only increased with the latest rounds of, saber rattling that Trump has done against Mexico, Canada, the Eurozone, and others. So I think the Fed is going to have to sit here and wait and see what happens. But Powell's doing his job, and I think he's looking at the headlines like other people are going, that's what he's doing.
Jared, just curious to bring you back here. I mean, if you did see Trump make that move and try and fire the Fed chief, you'd make a beeline to the dollar and rates. How do you expect the response and reaction would be in those markets, Jared?
I think it's unpredictable. It introduces a level of uncertainty, and one of the mantras that investors live by is that we, as investors, do not like uncertainty. And so are we going to definitely get a new Fed chair who's definitely going to be easing and really ease his foot off the brakes and really pump that liquidity spigot? Well, that could have unintended consequences. And as I was pointing out before, it really comes back to bond interest rates. The 30-year was something we took a look at before. I want to show you what's going on with the 10-year as well. So the 5% level is important in the 30, the 4.5% is important in the 10-year. And if the Fed were to really release those liquidity spigots. Let's say that happens. Maybe there's a new round of QE. Maybe there's 4, maybe there's 6 rate cuts. Well, that's going to affect long-term rates because there's a term premium built into these rates. And once you lose the long end control, once you lose control of the long end of the bond market, things can kind of go off track here. And as we saw earlier today, when the 30-year touched that 5% level, stocks rolled over. And so there's a definite causal relationship in those two. I would not want to mess with that. And I wouldn't be surprised if Trump was monitoring the bond market today. And I think we came into this presidency thinking that the last Trump presidency was really about stocks, whereas this was going to be about bonds. And that's what I see playing out here today.
All right, joining us now for more on this very topic, we got Jeff Lacker. He is Senior Affiliated Scholar at Mercatus Center and former Federal Reserve Bank of Richmond President. Jeff, thank you so much for being here. I want to get your take on the big headlines today. Jeff, what we were just discussing there, we had these reports. You saw Jeff Trump was going to fire Jay Powell. The president comes out and says, no, he's not planning on doing that. What did you make of that back and forth?
So the initial story was not inconsistent with recent signals coming out of the White House about maneuvers to try and use the building project and scandal over that or controversy over that as a pretext to firing Powell. So I wasn't surprised to see the thing this morning. The walkback wasn't a surprise either. I mean, the way financial markets reacted, it's consistent with other reversals the administration has made to policies that provoke adverse reactions in financial markets. So it's not a surprise. Unfortunately, it's consistent with an administration that does not seem to be aware of what is in its best interest ultimately.
Jeff, can the president actually fire the Fed chief? Is that even an option?
So as I understand the law, and as it's been, and there's some ambiguity about this, but the for cause is a possibility. That is, if he has cause. Now, cause isn't spelled out in the statutes, but malfeasance or gross negligence, things like at that kind of scale might satisfy that criteria. Whether this building project dust up satisfies that criteria or not, I sure don't know. But it doesn't strike me as beyond this administration to rely on a pretext that has a bit of thinness to it.
Jeff, on this next question, I'm asking you to speculate. I realize that, but I am just curious. What do you think Jay Powell makes of these reports? He's watching these headlines too.
I think it's something he regrets and isn't happy about, but I don't think it changes what he does. I just don't think it changes what the Fed does. I think they go straight down the middle of the fairway and call it the way they see it.
Trump has made it clear, Jeff, what he wants. He wants them cutting. He thinks they should have already been cutting. They're late. Jay Powell has indicated, listen, he wants more data. He wants to see how the tariff inflation plays out. So he's willing to wait and see right now. In your opinion, is that the prudent move?
I do. I think the yesterday's CPI report indicates that it's certainly plausible that a pulse of inflation is in the pipeline and is going to show up over the next several months. I think it'll be several months before we have a sense of the magnitude of that. The September data isn't going to come until October, so it'd be surprising to me if before December, say, they had a really good idea of what the magnitude of the inflation effect of the tariffs is going to be. Until they do that, I think they gotta pretty much hang tight.
Chris, I want to bring you in as well. In your opinion, interested to get your take here, Chris. The Fed, wait and see, in your opinion, also the prudent move at this point?
Oh, absolutely. I mean, if we take a look at, not just the June CPI report that Jeff mentioned, we could take a look at the June ISM pricing data and seeing that trend higher as well. And like I mentioned, a few minutes ago, we have the prospect of further tariff escalation, another round of uncertainty. I think we have to wait and see what happens both in the pipeline as inflation continues to move through from existing tariffs, but see if we have even more tariffs coming that could jumpstart this concern all over again come early August.
Jeff, just to play the other side here, there are some who argue, and I'm interested to get your response to this, they say they should be cutting. And the argument seems to go like this, that to the extent that tariffs impact prices, it will be, Jeff, one time. It'll be transitory. It's going to come. It's going to go. It'll ease. It'll subside. And meanwhile, let's say growing weakness in the labor market. Yes, they should be cutting. Your response to that?
So the prospect of it being just a one-time level effect on inflation, on the level of prices, that depends on the stability of expectations about future inflation. And that depends on the credibility that markets ascribe to the Fed's commitment to keep inflation low and to respond if inflation is surging and to offset any increase in demand relative to supply. So if tariff increases a restriction in supply, to keep inflation low, to make it a one-time level effect, you have to get people to postpone spending to some degree. And that sometimes requires an increase in real interest rates.
Jeff, as we sit here in July, I'm just curious, how many cuts would you expect this year?
0 or 1. If it was up to me, I don't think they'd cut. You see the movement in the dot plot in the direction of no cuts. I'm guessing that'll ultimately prevail.
So it's interesting, Jeff. You listen to the Trump officials, and here's an argument you'll hear. I want to get your take on this too. They'll say that their bet is most of this impact, they seem to be saying, is going to fall on the foreign producers, Jeff. That the tariff is going to come and they're going to cut prices in response and eat the margin. That's who's going to take the hit, not Jeff and Josh.
I don't think we know. The economics suggests that foreign producers selling to a global market, we are price takers in some of those markets, and I don't think we have the buying power to really muscle those prices down. Keep in mind that what adjustments might be made in the short term just to maintain a supply relationship aren't necessarily how things are going to play out a year or two down the road. A foreign producer might be willing to take a hit for a couple of months just to keep the relationship going, keep the supply chain going, but down the road, if it becomes permanent or they ratchet up even further, you'd expect some adjustment that would ultimately put the cost of the tariffs on the American consumer and the American businessman.
One last question, Jeff. I'm just curious to get your take on the big, beautiful bill, Jeff. I asked economists like yourself how stimulative that's going to be. And I would say mostly, Jeff, the response I get is kind of tempered response. And I'm just curious whether you think now that CEOs and CFOs have that certainty, Jeff, they have that clarity, is it possible that actually encourages more economic activity than maybe we estimate?
It's certainly plausible. It's certainly conceivable that business investment could pick up. We certainly have technological developments in train in our country that suggest that the prospects for productivity growth are reasonably positive. Keep in mind, though, that to the extent that that raises the expected real growth rate and growth rate of real income, without a commensurate increase in real interest rates, people are going to want to pull that future real income gains forward in time to today and spend today. So to the extent that growth comes up, we saw this in the late 90s, real interest rates ought to rise as well.
Jeff, always great to see you and to have you on the show. Thank you, sir.
Thanks, Josh. Take care.
We are just getting started here on Market Domination. Coming up, Johnson & Johnson is one of the day's big stock movers, even in the face of tariffs. We'll explain why. Some of America's best-known coffee and burger chains may not be the best for your portfolio. That's according to one expert. We're going to have that story, too. And Trump versus Powell, we continue to explore the very public feud and its impact on markets. All of this when we return. Stick with us. President Trump reiterating his stance on drug tariffs on Tuesday, saying that those tariffs will probably be implemented at the end of July. For more, we're bringing in Yahoo Finance senior reporter Anjali Kamlani. Anj.
That's right, Josh. We did hear from Trump saying that he's going to be implementing these pharma tariffs probably by August 1st, which is when we know he's looking at implementing others. And this is something the industry has been bracing for some time and also hoping to lobby on behalf of. We know that the industry has talked to Trump directly. We've had companies talk about that and try to encourage him to look at the long-term plan that includes commitments in the billions, multi-billions of dollars for reshoring manufacturing in order to avoid these tariffs. We have also heard that Trump has talked about, or at least thought about, phasing in those plans for the tariffs. I had a chance to speak to Johnson & Johnson CFO Joe Wolk today about that on the back of their earnings, and here's what he had to say about it.
To their credit, the administration has really engaged with business, certainly our business at Johnson & Johnson, but also the industry, to just understand the dynamics of the complexity of our business. We can't pick up a supply chain and move it overnight. We can't construct new facilities overnight. But we were really proud to announce earlier this year a $55 billion investment in the U.S. over the next 4 years, which will add additional manufacturing capacity here in the U.S.
And the companies have been hoping that moves like this are going to help thwart any kind of tariffs on them. We know that J&J in particular has had to experience the medical device tariffs. Those have already been in place. So we've seen a little bit of back and forth already with the industry.
And Anj, you also talked, I know, to the J&J CFO about China. Tell us more about that.
Yeah, that's right. So sorry. China has emerged as kind of an interesting market. Before, big pharma companies used to be invested in China and think of it as a market for them. But it has been changing the last few years. We've seen licensing deals from these companies spawning some ideas about national security, and that has been where the ideas like the Biosecurity Act has come from. But what we've seen recently is big pharma take an interest in some of these deals and watch the market to see how plans pan out. And this is because China has been focused on really growing their biotech and their innovation sector, and that's part of a long-term plan. So we've seen some of these companies maybe think about how those companies in China are going to affect the market and the market share that they have. We saw recent news of maybe a Lilly competitor with obesity drugs doing well or having some kind of results there. I had a chance to talk to Joe Wolk about that and how he's thinking about Johnson & Johnson in that market.
We do know that the China 2030 plan has targeted as one of their priorities investment to a significant degree in their overall healthcare system, and that's inclusive of innovation. So we certainly want to be mindful of that. It's a large market. Our products are appreciated there. And MedTech, we are still the largest supplier within the country.
So it looks like, at least for the medical devices, Johnson & Johnson's safe, but they didn't say too much about the pharma side. So I guess it's just a wait and see on that front.
All right. Thank you, Anjali. Now time for some of today's trending tickers. We're going to start with ASML, that company narrowing its guidance for the remainder of 2025 amid tariff uncertainty. So this one was interesting, Chris. It sounds like we have a company kind of walking back the forecast here, that sales will grow next year. They're walking that back. They seem like they're pinning it on trade disputes in part. CEO saying we continue to see increasing uncertainty driven by macroeconomic and geopolitical developments. While we still prepare for growth in 26, we cannot confirm it at this stage.
I think you're going to hear a lot more about that as we go through the earnings season. You know, not to harp on it, because we were talked about tariffs and trade deals and that uncertainty, but it's kind of a cover if you want to think about it, right? If you're a company and you're planning, whether it's your capital spending budget or your outlook for what consumers are going to do, whether or not others will be, taking your products, you don't really know the landscape. You can see the data, but this tariff uncertainty is just amping up questions that you just don't have the answers to right now. And I've been thinking that this earnings season, more companies than not are likely to guide more conservatively because we don't know that. I'm a little concerned about where the S&P 500 is, right? Earnings expectations come down. That either means the market comes down or the multiple goes higher. And at what point do people start to question the market valuation?
To your point, the CFO of the company saying customers, I thought this was interesting, customers more concerned about the tariff discussion today than they were 3 months ago. Countries are in full battle mode again when it comes to tariffs.
100%. I mean, again, Trump has kind of pushed it down, and we've got now 30%, 35%, potentially higher. How do you plan in that environment if you don't, because you don't know if that's going to be it? Could it be something else? Could it be even higher? If something happens and Trump says, we're going to do this. So it's a very uncertain time, hard to plan for.
All right, let's turn to another one. That would be Palantir. That's not getting a lift at Mizuho, the firm highlighting a bright spot for revenue growth. So Mizuho upgrades this one. They go to neutral, right? And here's what they say, Chris. They say, while checks on Palantir's business are very limited, we heard that enterprise inbound activity rose materially. We anticipate ongoing strong AI adoption in the U.S. We believe Palantir has a legitimate chance, they say, to accelerate total revenue growth for a fifth consecutive quarter.
Yeah, that's why we own the stock in the Pro portfolio at the Street. That's why we bought it, around 70, 75 on that pullback earlier in the year. What confounds me, though, is an upgrade to a neutral with a price target that is lower than where the stock is. Doesn't seem to make sense. If I were to sift through it, put my buy-side hat on, sounds like he missed it, and he's kind of trying to catch up.
They acknowledge, they call it a sky-high valuation, is how they put it, Chris. But the robust growth story appears intact. Their target, it looks like 135. To your point, the stock has been, of course, a monster.
Yeah, it has. It has. I honestly think, Josh, that you're saying, wow, we see big growth out there, but we're concerned about the value. You're talking out of both sides of your mouth. Which one is it?
Make a call. All right, lastly, ARM Holdings getting an upgraded BNP Paribas, citing potential upside from ASIC chips. So they upgrade this one to outperform. Their target's 120. What do you make of that one, Chris?
Again, a little late to the party on this one.
Big move off that April low.
Yeah. But I mean, look, we're going into the seasonally strongest part of the year for their key end markets. They are trying to move more into data centers. So it does make sense that, you want to be where the growth is going into the second half of the year. Personally, I prefer NVIDIA, Marvell, and Qualcomm over this, but that's just me.
To your point, the analyst does say there is still significant upside to be had. That's what they're telling clients. Coming up, it is the latest edition of our series, Goodbye or Goodbye. We're taking a deeper dive into two stocks to help you make the best moves to your portfolio. Stick around, much more market domination still to come. Welcome to Goodbye or Goodbye. Our goal here to help cut through the noise and to navigate the best moves to your portfolio. I'm here with Tematica Research Chief Investment Officer. That would be Chris Versace. Chris, let's go through the first one you like. This is a buy, and it is Costco. Now, this stock hasn't done a whole lot so far this year, up like low single digits. Most on the street, the majority do say this one's a buy, so you're in good company. Let's go through the reasons. The first reason you say, winning consumer wallet share.
So Costco is a great company to begin with, but as an investor, they give us a lot of information. One of the things I really like, they're still one of the retailers that actually reports monthly revenue numbers. So what we can do is size this up against other data, like what we'll get tomorrow, for example, the June retail sales report. Costco's already reported its June revenue. U.S. comp sales adjusted up about 5%. We have a nice barometer to measure that against. And if we do that over the last several months, it's clear Costco is taking consumer wallet share, and it makes sense. Folks are trending down. They're concerned about inflation pressures. They're leaning into what Costco has.
Bullet point number 2, another reason you say this one's by differentiated membership business model.
Yes, so when we talk about Costco, we have to remember it's a membership warehouse club. So you pay your fee and off you go to shop. But when we amass those fees, they're a significant piece of the company's overall pre-tax income, depending on the quarter, 50, 60%. Very different than a Walmart, very different than a Target. It gives it an air of predictability that we like, and it also kind of says that when things get a little rough, there's a nice rock-solid base for their earnings.
And a final reason you say this is a smart place to commit capital, expanding warehouse footprint.
Absolutely. So, Costco continues to build out the number of their locations, both in the US and internationally, but it's kind of a great feeder business because as they expand the warehouse footprint, they get more members, they continue to build that high margin membership fee revenue that they have.
Now, you made your case convincingly, Chris. Before folks jump in, though, let's talk about the downside risk you got to think about.
Yeah, so a lot of folks will talk about consumer spending and stuff, but I continue to think that folks who are looking to stretch their disposable spending dollars, they're going to Costco. So that's not as big of a risk for me. For me, given the importance of that membership business model, we have to track renewal rates. They're typically above 90%. If we saw a big drop in that, that would be worrisome to me.
All right, so that's our buy. Let's move to one you're not such a fan of, now Target. Now this one has already been plenty beat up, Chris. You say it's still worth avoiding here. Let's go through the reasons why that. The first reason you say avoid Target, consumers trading down.
Yeah, absolutely. When we take a look at, various survey data, consumers are trending down, off-price brands, trying to stretch those spending dollars, the very reason we expect them to go to Costco. So, when you look at Target, it's kind of a disposable income type of place. They're not big in grocery. You can't buy in bulk, hard to arguably stretch those dollars. So I see them kind of losing wallet share while Costco gains it.
Second reason you say this is one to avoid, market share concerns.
Well, exactly. So when we talk about consumer wallet share, we already talked about Costco, they're taking it, but we think about Walmart, we think about Amazon, particularly coming off of Prime Day and expanding that base, adding more digital shopping holidays throughout the year. How does Target compete? It's poised to lose more market share in my view.
And another reason to avoid it here, margin pressure.
Yeah, so a lot of retailers, what they're trying to do, whether it's Albertsons, Kroger, or even Target, they're trying to hold the line on prices so people continue to come in. Well, if they continue to hold the line on prices and they're losing market share, it's going to hit their margin dollars. The falling margin dollars, not good for EPS outlook. So I think there's some downside EPS risk there.
All right, so before you avoid it, though, as we do avoid it, what are some reasons you could be wrong, Chris? What's the upside risk on this one?
So the biggest one is, if we think about Target being tied to discretionary spending, if we see a reacceleration in disposable income, that would be a reason to turn around and revisit Target. But to see that, we're going to want to see a pickup in job growth. We're going to see a pickup in wages. Those would be the flags to look for.
All right, buy Costco, avoid Target. That's what Chris has to say. Thank you, Chris, and thank you all for watching Goodbye or Goodbye. More market domination. That's right on the other side. Melius Research initiating coverage on a number of restaurant stocks, including sell ratings. With some top names like Starbucks and McDonald's, and with no shortage of options for what and where to eat, it might be time for investors to start rethinking how to value names in the food space. We're navigating how to play the restaurant sector with the Yahoo Finance Playbook. And joining us now, we got Jacob Aiken-Phillips, VP of Consumer and Retail Research at Melius Research. Jacob, it is good to see you. I have to ask you a question, Jacob, because I got to tell you, I've talked to a lot of financial analysts, Jacob. I don't see a bio and a background like yours, my friend. Am I reading this right, Jacob? You were a nationally ranked heavyweight wrestler, my friend?
Yeah. Well, I qualified for nationals, for Cornell back in 2010, 2011. Oh, no, 2015, 2016.
Cornell. It's a legit Division I program. So that is impressive. Knowing that, I'm going to approach this interview very respectfully, Jacob. Let's get into some names here. You initiate on restaurants. You don't like everything you see, Jacob. So let's start there. McDonald's, for example. Now, you acknowledge to your clients, you call this a world-class brand, but it's a sell, Jacob. That's what you're telling your clients. Why? Why is McDonald's a sell?
So just for a little context, I've previously covered retail, C-stores, and food distribution, and I just initiated on restaurants. And I'm really taking the perspective of consumers don't choose between food away from home and food at home, but they choose how to do their next meal occasion. So McDonald's isn't just competing with Taco Bell or Wendy's, it's also competing with Walmart and Kroger for food. So with that in mind, my team took a deep look at the value. We did a cost per calorie analysis, looked at how pricing and traffic trends have happened since 2019. And McDonald's and Starbucks are just two names that the pricing seems to have outpaced the consumer experience. Both, I do acknowledge, are great global brands with great relevance, but especially in the US, it just seems that the value has kind of gotten out of whack, the value perception that the consumer has.
What about the snack wrap, Jacob? I've been talking to my colleague, Brooke DePalma, about that. Isn't there a lot of buzz about that?
Yeah, definitely super popular. I tried it, and my associate actually just had both of them today. It's definitely good. I was a big fan of the previous snack wrap. And like going into the quarter, I think that people are already not pessimistic, but they understand that the trends have been bad and the snack wrap is only upside, which I acknowledge. But my thesis is more structural over the medium term, that they're going to have to reconfigure the value equation.
What about Starbucks? There's another one. That's a sell. Is it the same basic thesis, Jacob? Pricing has just outpaced the consumer experience?
Yeah, and you can see it like almost more directly with Starbucks because they give data on traffic versus ticket or check, I think they call it. And it's checks up 42% since 2019, fiscal 2019, and traffic's down like 10%. Check is more than just pricing, because they've introduced food and like people are buying more items. But just in general, traffic's down, pricing's up. And it's a hard value equation to fix, and they've been trying to reinvent themselves over the last year or two, and it's stretched longer than people have expected. And I expect it to be a bigger burden on their margin and growth profile over the next few years compared to what the consensus seems to believe.
And so when you told your clients on that one, Jacob, that one was a sell, if they came back to you and they said, how could you be wrong, Jacob? What's the upside risk I need to think about? You would tell them what?
Well, the new CEO, Brian Nichols, is very good, very well respected. The market seems to believe that the strategy is going to work. The whole third place, really focusing on basics, putting some more labor back into the stores. It's just, does that translate into traffic? And can their promotions like the summer berry refreshers or the ice horchata, can that drive traffic beyond just the value equation? Because value is more than just price. Value is convenience, it's innovation, newness, and just everything that the consumer looks for. But the price equation has gotten out of whack.
Now, we've got your sales. Let's talk about what you like here. You say you favor companies with strong unit economics, disciplined growth, capital allocation, long-term brand relevance. That seems smart. Before we get to your number one, I'm going to save that. Let's talk about one that does fit that bill. You also do like here Dutch Bros. That's a buy. It's enjoyed a run. It's up around 20% this year. It's up around, Jacob, 50% over the past 12 months. Why is this still a smart place to put money to work?
Yeah, this is one of my calls that is definitely not out of consensus. I think Dutch Bros has a great story. There's some interesting financial dynamics happening because of the way that the company is organized that is a bit more difficult to understand. But just looking at the story, the growth profile, the unit economics, they have such a big white space and a long runway for growth. And as I don't want to compare them directly to Starbucks. I'm not saying that they're going to become a Starbucks, but who knows, maybe. But their shops are super efficient, drive-through focused, customizable. It's energy focused, and they target younger crowds. The brand's super relevant, and whenever they open new stores, there's a big flurry to try the new products. It's a really interesting story that will take place over the next 10, 20 years.
Chris, I want to bring you in here because it just so happens, my friend, you also
That is correct.
are a fan of Dutch Bros. How come? Do you agree with Jacob's arguments?
Yeah, so we own the shares of Dutch Bros in the Street Pro portfolio. We've owned them for some time, and we do like the Dutch Bros story. Jacob, rattled off a number of different reasons, but I'll boil it down and keep it a little simpler. A time-tested strategy for these restaurant stocks is what I like to say west to east expansion. There's a lot of runway at Dutch Bros to do that, and you could trace this back, through restaurant stock history, if you will, whether it's McDonald's, Starbucks, Dunkin' Donuts, Habit Burger, which got acquired, and the like. There's always when you have a strong geographic expansion, you want to be behind that. By comparison, I think if you map the number of stores that Starbucks has in the US compared to Dutch Bros, very, very small overlap. In other words, Dutch Bros, even if they don't mimic the entire Starbucks footprint, they still have a long way to go, to Jacob's point. I also like the fact that they are going to be refreshing and expanding their food menu next year, which should drive up their average ticket as well. So we see a lot of positive levers over the next several years for Dutch Bros. I won't be as bold as Jacob and say the next 20 years, but certainly a lot of runway behind Dutch Bros.
So Jacob, you and Chris, you make a compelling case here. What's the downside risk, though, I have to think about?
Well, I feel like with any growing company, it happens across retail and restaurants. If there's a break in the cadence of unit growth, it can be detrimental to the stock. And if comparable restaurant or comps slow down, that can also affect it. But just generally, if you hold the stock for a long time, I think that any short-term headwinds from those, like increased cost to build, et cetera, will be overcome.
Jacob, we're going to end here. We're going to save the best for last. This is your number one pick, you tell clients. Yum Brands. Now, why Yum Brands? How come? Most on the street, Jacob, I'm just looking, most of your colleagues look like they're on the sidelines for this one. You are bulled up. How come?
I don't think people appreciate the capability and potential future revenue generation of their tech stack that they're rolling out. There's a lot of things to like about their international growth, capital light model, but the Byte by Yum tech stack that they're rolling out is going to revolutionize their system. It's going to improve operational efficiency, demand forecasting. Eventually, it will be tied into AI personalization for revenue generation. But then beyond that, they can license it third party as for other franchisees or other multi-brand operators that need a multi-brand platform to help manage their system.
To your point, Jacob, I could also eat my weight in Taco Bell, by the way. That is delicious. Jacob, thank you for the picks and your time, sir. Appreciate it.
Thanks for having me. It was a pleasure.
While we are wrapping up today's market domination, don't go anywhere. We've got you covered with all the action following the closing bell.